Okay, here we're going to be looking at how we'd record a gain in a consolidation of two businesses. The example will be for Corporation A, the parent, purchasing 100% of Corporation B, the subsidiary. First, I'll go through an example here of how we'd calculate goodwill, and then using the same procedure, show how we'd calculate a gain, and then show how this gain would be recorded here on the balance sheet for the consolidation of these two companies. Okay, let's look at the balance sheet here for Corporation B. We know its book value or its carrying value here for the assets, the liabilities, and shareholders' equity. But what we have to do is determine the fair value here of these assets and liabilities at the time of the acquisition here of Corporation B by Corporation A. And the difference between the book value here and the fair value are the adjustments that have to be made for this consolidation process of Corporation A and Corporation B's balance sheet. So looking at our value analysis here, in this case Corporation A purchased the net assets or their fair value here of Corporation B, and they exchanged common stock or their common stock for these net assets. So in this case Corporation gave Corporation B in this case $860,000 worth of their common stock. And to determine the fair value of our net assets, what we do is we take the fair value of our total assets here of $920,000 and then subtract the difference here with the fair value of the total liabilities of $160,000, and then the difference here would be $760,000. Now that's the fair value of the net assets here that Corporation A is acquiring from Corporation B. And then to determine if there's any goodwill in this acquisition here, we take the price paid. In this case it was $860,000 worth of common stock issued by Corporation A to Corporation B, and then we compare it with the fair value of the net assets that we acquired here of Corporation B, in this case $760,000 worth, and you can see that the difference here is $100,000 worth of goodwill that was involved because the price paid here was greater than the fair value of the net assets received. Okay, so now looking at our distribution schedule, the fair value of the subsidiary was $860,000 here. That was the common stock that Corporation A issued to Corporation B in acquiring Corporation B, and then we take the less the book value of Corporation B's here total shareholders equity shown up here on their balance sheet. So comparing the total shareholders equity to the fair value of the subsidiary here of $860,000, we got an excess of the fair value over the book value here of $525,000. Now that's the amount that has to be accounted for here when we make our adjustments to our accounts here in the consolidation process. The $525,000 here has to match the our adjustment account here of $525,000 has to equal this excess of the fair value over the book value. So looking at our adjustment accounts here, all I did is take in the book value here and compared it with the fair value for Corporation B's assets and liabilities. And then when getting down here, just to note this here, for the liability accounts, I show them as a negative figure here, but they actually are increasing when we do our consolidation process here for our liabilities. But I show them as a negative amount here because they subtract the other side of the equation, or they subtract from the asset accounts here when determining our total value of our adjustments. And I also have the goodwill here included here in that in this acquisition process, and it was $100,000 in this case. So these adjustments to the subsidiary accounts in our consolidation process here is adjusting the subsidiary or Corporation B's from their book value to their fair value here. Now in this case the total adjustment has to be made in the subsidiary accounts based on, in this case, 100% acquisition. Okay, using the same balance sheet here, let's look at how we'd calculate a gain here on the acquisition of Corporation B by Corporation A. So in this case, our fair value of our net assets are the same here, $920,000 for the total assets, less $160,000 here for the total liability. So our fair value of our net assets here is $760,000. But now to calculate a gain here, this is where the price we paid, in this case it would only be $700,000 worth of common stock that we issued to Corporation B for their net assets, and we would have received here $760,000 worth of fair value for their net assets. So the net assets we received here is greater than the price we paid here, $760,000 versus the price we paid here of $700,000. So in this case, taking the difference here, we have a gain here of $60,000 on this acquisition here. Okay, so looking at our distribution schedule here for this gain, the fair value of our subsidiary was $700,000. That was the common stock that we issued to Corporation B for their assets and liabilities. And then we subtract out here total shareholders' equity here of Corporation B, which still remains here at $335,000. And then the excess of the fair value over the book value here is $365,000. So going down here and looking at our adjustments accounts, we have to subtract out this gain here of $60,000 here in order that the total change here in our adjustments accounts of $365,000 matches with the excess here of the fair value over the book value here in our distribution schedule. Okay, for our journal entries here to record this consolidation, the first thing we'd have to do is adjust the subsidiary accounts here, or Corporation B's accounts here, for the changes here in our asset and liability accounts, shown here as in our adjustment accounts here. And then going up to our balance sheet here, what we're really doing is we're combining Corporation B, or the subsidiary accounts here, at their fair value with Corporation A, the parent, in this consolidation here. So taking the fair value of our assets and our liabilities here, we'd combine that with Corporation A, the parent A's accounts. Then finally, we'd have to eliminate here the investment in subsidiary B by Corporation A and this consolidation here. And we'd also have to eliminate here the carrying value of the stock and the retained earnings that would be sitting here in Corporation B's books here. And then we also have to increase our retained earnings here for Corporation A by $60,000. That would be the gain that we recognized here on this acquisition here. So we credit or increase our retained earnings here for $60,000. Now going back to this investment in a subsidiary account, we'd close that, or we'd eliminate that in two parts here. The $365,000, that would be the excess of the fair value over the book value in this case for Corporation B, and that's really these adjustment accounts here. In the adjustments that we made to the asset and liability accounts, they would balance here with this $365,000 that we're eliminating. And then finally, we have this $335,000 worth of carrying value for the stock and the retained earnings for subsidiary B here. That would be eliminated too as well here in this investment account. And then looking at our subsidiary account here for Corporation B, we'd reduce that or eliminate that here, and it was sitting at $335,000. That was for the carrying value here of the stock and the retained earnings for Corporation B. So we debit or reduce that by that amount here of $335,000. So at the end here, our investment in our subsidiary would be reduced to zero, as well as the subsidiary's equity accounts. That would also be reduced to zero.